We're going to kick off the next panel, and it's one that we're excited about. We're going to piggyback on the prior two. This time around, we're going to talk about NORS in the context of slashing coverage, and specifically insurance as a mechanism, to cover against that. And so, also just to contextualize, why that's important as we think about broader institutional adoption in the staking space. Mitigating risk is a key factor for a lot of these firms in doing so, and insurance is a key tool in making that whole process less costly, more in line with their business models is a critical factor in that. But let's start with some intros. I'll kick it off first. I'm at Blockdaemon. I lead our business operations and strategy team. It's a mix of kind of go-to-market things and as well as on the internal side. And one of the key elements of that, as it relates to this, is thinking about our slashing coverage and insurance tools around that. Previously, I was in traditional finance for a few years and have been in crypto for the last 3 years. But Josh and Glenn, do you want to introduce yourselels?
Yeah, hey guys, Glenn Morgan. I lead Aon's digital asset practice. So I look over our book of both like crypto native and adjacent business for commercial risk, which is like direct insurance products, but also working on the innovation side to help figure out where the industry has unmet needs, which is a lot of traditional insurance products that try to get retrofit to risks that are or might not be good for the new technology and applications that we see today. So that's kind of my background. I've been working in crypto since around about 2017, and I've seen the industry evolve a lot since then. So.
Cool. First of all, nice seeing so many friendly faces today. My name is Josh. I've been in the space for about 6 or so years now. Actually started my career at KPMG. I'm a CPA by background. I was leading some blockchain files back then. Ended up working at Bitfarms, which is one of North America's largest Bitcoin mining companies prior to them going public. Took them public. And then now I've been working at Figment for the last little over 3 years. Shifted a lot of roles during that time, but my focus has been mainly on the product side as well as on risk. So the products are twofold. One is the reporting capabilities that we provide our customers, and the other is basically the coverage that we provide our customers, as well as the insurance that Figment sources, and that's how I become so close with Glenn here. We work with Aon as our broker, so yeah.
Well, great. Let's start off just by contextualizing a little bit of what we're talking about. So, we're talking about insuring against slashing risk. And if we think about that historically, especially when you think about some of the institutional node operators, the risk of that, the number of major slashing events is very low, if not, almost none. Blockdaemon's perspective, we've never had a slashing event on our Ethereum validators. Similarly, I'm sure for many of the institutional node operators here. That combined with when there is a slashing event, the likelihood that it is a major amount of your principal that is slashed is also low. Yet the amount of customer demand for insurance products in this space is the demand for that is very high and has only been growing. And so let's touch on that duality for a bit first. And Josh, maybe from your perspective at Figment, can you talk about what I just mentioned? Do you see the same, and what are some of the factors around the demand that you're seeing?
Sure, and I'll get to the question, but I want to take a step back. We've talked a lot about slashing today. I think it's important for some of the folks in the crowd that might not know there's different types of risks associated with staking. The first is misrewards. That's basically if you're down and not operating as you expect, you're going to have small amounts of rewards that you would have earned that you're not going to earn, but there's no principal loss in that situation. You have downtime penalties, which is basically if you're down for a certain amount of time, you're going to incur small amounts of what is slashing. But then there's also this double sign slashing risk that's been alluded to a lot today, and that's like the big scary monster in the room. I think part of the way to answer your question is I spend a lot of time educating customers about risks associated with staking. They come in saying, I'm scared to lose it all. And the reality is that in only very small, very unlikely events can a catastrophic event happen that would result in losing the entirety of your principal. So there's part of it similar to NORS being almost like a way of educating customers who may not understand all the controls in place that are required to be an institutional grade staking provider. It's that level setting, basically explaining and showing on-chain that there's only ever been 450 slashing events on Ethereum. The maximum number of validators ever slashed in a single event is about 100. And to get to that large-scale, catastrophic, full principal loss would require nearly a third of the network to be slashed at the same time, with roughly 1 million validators up and running. That would mean 333,000 validators would need to be slashed in the same event to hit that doomsday scenario. And again, I want to contrast that to being the maximum ever in an event is 100. So usually that helps level set with customers a little bit, but we still hear very often, I want 100% coverage. And that's something that we need to fight against a little bit. Not necessarily fight, but educate that that's not necessarily a necessity. It's not really the reality. It's also important to note that we've talked about Ethereum this entire time. Every network has its nuances, and I'm sure we'll get to that after a little bit when we're talking about insurance policies in the space. But NORS right now is focused purely on Ethereum, but I think it is important to also mention that for some networks, there is no slashing. For some networks, slashing is 10%. So it's really a nuance that you need to fight with. But ultimately, it's partially education, and then part of it is then bridging the gap between what is a staking provider willing to absorb on its balance sheet versus what can we offload or into an insurance policy.
Yeah, it's really well said. And maybe in addition to education as well, it can often just be an internal policy that they need to cover a certain amount, or there's a regulatory reason in that specific region that requires them to do that, despite kind of some of the things you mentioned on lower risk. So I think some of the challenges today in the staking insurance markets, 3 of them in particular that I want to touch on. One is capacity and some limitations there. 2 is pricing around these products, and the 3rd is around procurement. But let's just start with capacity constraints at the moment. We touched on the demand from our perspective. I think we've talked about this a bit, as well as the sheer amount of insurance coverage that is out there in the market today just does not meet the amount of demand that we're seeing from customers. And Glenn, from your perspective, you're seeing this often. What are some of the reasons why, as Josh is mentioning this demand, the market has not necessarily caught up, and what are some of the constraints there?
Yeah, I think there's a few reasons for that. I think that part of it is like understanding the dynamics of supply and demand and like what it takes to be scalable for insurance products. And we have some of the insurers here today who write slashing policies, but it kind of starts with, any insurance policy is going to start with your primary terms and conditions. That insurance company is going to effectively write what everybody else, if they want to add capacity to a program, is going to follow along to. So right now we have, call it, 5 to 10 insurance companies who will write a slashing policy. But usually, where it starts is that you have a competition for this primary insurance, and when the insurance companies are already needing to charge, higher rates for the initial layer of insurance, they start to see what this would cost if we stacked this up and scaled it. And really, because the margins are so tight for the industry right now, no one has really tested to see how far that capacity can go. So while the industry might view it a little bit as like capacity constraints, it's trying to find an intersection between node operators and insurance companies about where they still see value. So this is at this point, even for most of the insurance companies who are writing this coverage, you could say it's still an opportunistic type play for them because they don't understand the risk, as well as the node operators do. It's very new. You can't look at a 10-year loss history like you might do for like a casualty or property insurance program. But like Josh mentioned, you do have on-chain history that you can see. You can look back in the entire history of Ethereum and see, like, what can we learn from these slashing events that have happened. So it's encouraging that there is so much data that you can start to put like actuarial thought into. But I think for insurers, especially the ones who would play more of an excess capacity standpoint, they're still waiting to see people be a little bit more aggressive about purchasing that capacity before they layer it in. And then conversely, on the other side, I guess Josh can probably say more about this, but the node operators are a little bit more hesitant because whether you buy like $5 million or $10 million, you still have clients who are asking you for $200 million. So where does that put you? So.
You mentioned one of the reasons why there is around understanding the risk. So, in the context of NORS, so what specifically can NORS do in terms of node operators and the industry more broadly adopting that standard? How might that positively impact the ability for insurers to provide more capacity over time?
Well, I think it's a fantastic way to get started with the conversation because. You start this conversation with 80% of the rest of the insurance marketplace, and they don't even know what staking is. So, what is a blockchain? What is proof of work? What is proof of stake? And then you start to layer in that conversation. Having something like NORS makes it much easier to say, we've already thought about this. We've talked to regulators, we've talked to all the leading industry participants, and we have a standard, we have something that can explain how these risk controls that you should be concerned about, how you can underwrite this business and avoid a loss. Now, not to say that like it's one thing or the other. I think a lot of things when you've got a new technology, you've got a new industry, it kind of is chicken and the egg where you're saying, do you need NORS to get insurance, or do you need insurance to get NORS? You don't want it to necessarily like one eat at the other, but I think that it gives us a good starting point for even people who are considering looking at this standard. This is what insurers and underwriters will start to be concerned about, and it can help bring down the pricing for those who are able to obtain it.
On the node operator side, anything on the capacity constraints and NORS that you'd also want to comment on?
I would just say that like everyone is expecting some level of coverage at this point. It's like table stakes, So it's just a matter of figuring out. We're going to talk about price, I have no doubt, but pricing is really that fine point. I don't know if I should just go into it at this point, but node operators are kind of put in a weird spot where we're only getting a small percentage of the rewards earned from customers. So as much as we'd like to say, yep, we will cover you for 100%, we don't necessarily have the balance sheet size. We don't necessarily make enough in term to be able to absorb the full premium the premium cost. So it's exactly what Glenn said. It's a chicken and egg problem. And what I see very often is the folks that are making the decisions, or the ones that are asking about coverage, aren't necessarily the ones that continue on with the relationship afterwards. So when you bring up that we're working with Aon or that we have on-chain coverage as an option, that excites them, but then there's no interest in the interest of putting out money to be able to actually pay for that coverage. So what this space is really missing is like a large enough customer to say, I don't really care about price. I need this 100% coverage for different regulatory reasons or for internal policy reasons. And that's what allows more competition to come into space for insurers. That's what helps drive down the premium costs. But yeah, until that happens, it's not feasible for staking providers to be able to absorb the premiums for a $200 million policy.
Yeah, no, I mean, I think that's a really interesting point. I hit the nail on the head, honestly, because I see a lot of correlation for what's happening right now with staking as to what was happening with custody, like back in 2019 or so. It was first there was not qualified custody, then there was limited qualified custody, and people were buying crime insurance for this. They were trying to level up these programs, and everybody would just buy what was necessary to close their deal. It's 5 and then it's 10, and everybody was asking for something more robust, something that looked more like what banks have, their excess deposit program. They wanted to see something with a B next to it, and it went from being people buying $5 million in crime insurance to then there was specie insurance arrived, and people were saying, somebody got $100 million, then somebody got $500 million, and it was kind of a race to the top until things started to dial back and people started to understand, okay, we don't need you to have 100% insurance on the $30 billion of assets that you're custodying. Same way I think that it's going to be in staking, is that like we'll find where that sweet spot is. But to Carrie's point earlier, like all the institutions care about or one of the main things they care about is like, do I have something to compare this to? Like, well, Blockdaemon has 200 million and Figment only has 10 million. Sorry, but if they say that, then they can't get that $200 million out of their head, and they're going to go with the other provider, even if the $200 million policy doesn't actually cover anything. So, I think we need to find, the mix of price and coverage that works. But I do think that for large scale adoption, that we're going to have to find something that doesn't eat away too much into the node operator's margins, that can also scale to a large amount.
Yeah, if I can just say one more thing, what's also interesting is I don't think customers necessarily, they ask about insurance policies once in a while. But ultimately, a lot of them, it's just a checkbox. It's like they don't care where that 100% is coming from, and they just want to see it as like, yes, you agreed to it in your terms and conditions or in your staking agreement that you're offering it. And that's something that we very deliberately try to avoid and to try to be transparent about, is if a staking provider is accepting this 100% risk at scale across all of their customers, and there is a catastrophic event, you're going to be in line with everyone else trying to make a claim, and ultimately it just ends up being a checkbox on a piece of paper. So, yeah, it's.
Yeah, I mean, I agree with both of you. I think also when we think about price in this space, we have to put it in the context of PRR, because that's ultimately from a customer's perspective, they're thinking about what is the premium priced at relative to the reward rate they might expect on that specific protocol. Today, if someone wants to purchase insurance on staking at scale and high coverage limits or amounts, that is oftentimes either wiping out the entirety of the rewards they might expect, or even oftentimes is priced higher than that. And so what that results in is much of the insurance costs being incurred by the node operators, and that's great. That's gotten us this far, but it's not the most scalable model, because you oftentimes might need to top up insurances where the customers are looking for their own procurement, in addition to whatever their node operator might have themselves.
Yeah, I think that's it's a tricky balance too, because from an underwriter's perspective, where does the insurable interest lie? Like if a customer of Blockdaemon was to come and say, I'd like to buy insurance for the assets that I'm going to stake. So they come to Aon and ask us to get insurance for the assets that they're staking with you. The underwriters would say, well, we can't underwrite that risk because we don't know what Blockdaemon's doing with our assets. So, there is a little bit of like this waterfall down of liability where it kind of rests with the node operators. But there's a give and take where especially I think we've seen in Europe where the financial institutions and asset managers that are staking with the node operators are willing to take on some of that cost. But it does draw the question that we'll kind of working on right now is like, well, if one customer has dedicated limits and then another customer wants to buy limits, is there an aggregated risk at the node operator level that we need to solve for as well, so that we're not putting up $40 million of limits instead of $20 million of limits?
Let's move on to the third element of some of the challenges in the market today in this space, which is procurement. I think it's been touched on a good amount actually in the last two panels, but just broadly speaking, it's not the most streamlined process. There's a good amount of duplicative diligence that's done, and it can oftentimes be just generally fairly bespoke. I guess to both of you, from each of your vantage points, can you first just comment a bit more on some of the biggest pain points and frictions that you're seeing, whether it's the node operator going through the procurement or potentially a customer who wants to do it themselves?
I would say from the perspective of a staking provider trying to get insurance, I feel like it's a little bit of an irony, is that at least from what I remember back in the day when we were getting an insurance policy for staking type risks, they didn't actually ask many questions about our controls, which makes me think, maybe it's changed, but it makes me think that we're paying more in terms of premium because they don't necessarily have a deep enough understanding in the nuances of the controls in place to reduce risk. So that's where I think NORS fits excellent, is an education of those, the actual insurers, so that they can understand, okay, this is a staking provider that's actually considered lower risk than some of the smaller staking providers that aren't NORS certified, in which case maybe that'll help drive down premiums, and you could corroborate or decline if that's actually going to be the case. But in general, yeah, there's similar to the due diligence questionnaires or RFPs we get from customers. The insurance application process is long with many questions about things that aren't necessarily just about staking either. So if this helps expedite that in any way, that would be great. But that being said, it's a once a year process. So although painful, it's less intense than the DDQ process that happens constantly.
Yeah, I think you touched on it earlier pretty well. It's like, and to draw back the comparison to custody, is like what's been the most effective in developing new products and bringing something that's like kind of a sustainable process into the market is someone who comes in with that like blank check approach. They're like, all right, our customers are asking for $100 million. We're going to get $100 million, and then we'll pay whatever the industry needs for that. Like by nature, insurance companies are risk averse. Like that's their whole job, is to avoid it. So in order to get some of the ones who frankly don't even really care to learn about something new to the table, it has to come at the right price so they can say, this is opportunistic, and if my chief underwriting officer ever asks me about it, I have a good excuse for why I did this. And that's for the larger amount of capacity. But I think bringing something like NORS to the market, and which is why we were so excited to participate in the development, it gives us something much more substantial than just like a price or a rate, to say that we've already like thought about this like very intimately, and like here are the controls that you need to be concerned about, and if you don't understand any of it, like we have a process, you have plenty of data in front of you to be able to ask the right people and start to educate yourselves on this. I think for insurers, it's not always the case that you underwrite a lot of businesses in fintech. You can't know everything about fintech, so you have to find a way to be effective in the amount of time that you get it. But we've definitely seen some more forward-thinking insurers, some who are here today, take some really big strides, and excited to see where that takes us.
Getting the signal, we're coming up on time. So one more question, just future looking. Insurance and staking is roughly only 3 or 4 years old at this point. So even in that short span, there's been a relatively large amount of progress. As I personally think about what the space hopefully looks like in 3 or 4 years, hopefully, generally speaking, there's adoption of standards like NORS, which help with a lot of the stuff you mentioned. There's also elements of aligning the insurance models with business models on the staking space, such as payment of the premium in token, in kind, which helps with a lot of the cost and operational elements. Just for you guys, quickly, what are some of the things that you hope has matured in the market in 3 or 4 years?
I would like to see insurance companies actually looking at on-chain data, and to try to not only just get qualitative information, but actually look at the actual on-chain history of a staking provider. I would love to see a checkbox, are you NORS certified during the application process as well. Same thing with DDQs with customers, is like if that could skip the line, and now that we have this NORS certification, we can look at the assessment, we could ask additional questions on top of that. I think that would help expedite the whole process. But ultimately, what I would love to see for NORS in the next 4 years is not just be ETH, for it to broaden across many more networks, and then that way NORS becomes the stamp of approval across all networks. Figment operates on 50-something networks, so a long way to go before we can get to all 50. But prioritizing the highest staked networks, maybe by market cap or something, and some way of assessing it. So I think that would be a great next step.
Yeah, no, I think that's, again, a great point with the standards and the underwriting, like NORS being able to help with this. I used to work, back in like 2017, 18, 19, I worked with a lot of like smaller investment, like crypto investors and RIAs and things, and like one of the first like things, are you registered with the SEC or not? If the answer was yes, it was like, okay, boom, like this is gonna be a lot easier, it's gonna take half the time, and like I already know I got 20 markets who are going to be interested in this, and hopefully over time we can get to the same place with NORS. For the overall, for the industry, I want to see us, like, I think the ETFs are going to help. If we can get to a reasonable place where we can include staking in ETFs, I think there's going to be more no pun intended, stakeholders who are like interested in participating in the overall finance of that, because it's going to help bring down, it's going to help them make more money. It's going to help the node operators make more money. It's going to help them be able to afford more to spend on risk infrastructure. So looking forward to that.
Great. With that, thanks guys. It was fun. Thanks for listening. Let's close it out.
Thank you, guys.